You'll always hear me say, and I've always said this, never buy real estate just for the tax benefits. It's got to cash flow first, and it also has to be aligned with your goals. Cash on cash is a measure of, did I make a good investment decision? Cash on equity is saying, is this still a good investment decision for me today? But look, if your number one goal with this whole real estate investing is to get out of your W-2 job and to stop working, you have to make sure that your money is working as hard as possible. And that's where I recommend doing the cash on equity audit.
How's it going, everybody? We are here with Ryan Bakey. Welcome, Ryan. Appreciate you being here, man.
Thanks for having me, guys.
Yeah, of course, man. It's an honor to have you here. You know, we just had another CPA on, and we're having you show up and giving your different angle. We've already got 12 people showing up. As you guys are rolling in, we're obviously going to take a couple of minutes here to get things going, to get things started. Let us know where you're all from. Everyone always does that whenever they're doing these things. And I want to give that a test, right? Like, I want to know where everybody is from while we're giving this presentation. We're actually going to be talking about a bunch of different locations and like how that's going to affect the STR tax loophole. So it will actually be kind of nice to know where everybody's coming from. But again, we're not going to get started until maybe like 3 minutes or 4 minutes from now, just so that we can allow more people to show up. But while we're doing that, Ryan, why don't you give yourself a bit of an introduction? Taylor, you'll follow up. I'll follow up from there, and then we can likely have everybody going. So just a little bit about who you are, Ryan, for anyone who doesn't know.
Yeah, my name's Ryan Bakey. I have an accounting and finance degree. I spent some time working at Big Four Consulting. So I did investment management and hedge funds. Basically, I was helping people who are already rich and wealthy become even more rich and wealthy. And I decided that I wanted to help not the everyday person, because I don't think every single person's called to build a tremendous amount of wealth, to be honest with you, but the person in their family that's going to change their family tree. And that's who I felt called to help. And so I left Deloitte to start my own CPA firm, my own tax and accounting firm, and focused on real estate investors and helping them save a lot of money in taxes. I have the largest community for real estate investors, over 11,000 people in my tax strategies for real estate investors community. And I'm really big about brand, putting out as much helpful information out there online, templates and free resources. So over the last couple of years, I've built a community of close to 30,000 people between all communities.
Very impressive, man. Appreciate you being here, of course. I know I've talked about this already once before on my Instagram post, but anyone who hasn't heard this, Ryan and I were both presenting for Rachel Gainsborough in Destin, Florida, and Ryan showed up a little bit later, and I'm just sitting there having a conversation with somebody. Ryan sits down in front of me, and I'm not kidding, within a minute, he was giving me advice on what to do with my business. And I don't think I've ever told you that, Ryan, but I genuinely thought to myself, like, who is this? Like, who is this guy talking to me right now? The more I listened to you, I was like, this is actually really good advice. The funny thing is, it had nothing to do with taxes, the advice he was giving. It was all about business. And I was like, this guy just understands things at a deeper level. And we just became friends that day, which was pretty awesome. Ended up going out to Chicago, meeting up with you, different things along those lines. So appreciate you again, man. Taylor, why don't you give everybody an introduction? While you're doing that, guys, let us know where you're from. We're going to get started very shortly. We're just doing some quick introductions. We just want to get everybody in here before we actually start getting into the presentation. So Taylor, go ahead.
Well, since you're asking everybody else, I'll just answer. Born and raised in Florida, never leaving, never left, never plan on leaving. When you get born in paradise, there's no sense in ever leaving where people finish. So I'm a Florida boy, tried and true. Washed up baseball guy. So looking at numbers all day is a natural fit for somebody who does underwriting. I'm constantly in spreadsheets, pro formas, underwriting short-term rentals. So acquisitions is my key, and I've kind of niched down to underwriting and acquiring short-term rentals for investors across the US. With acquisitions, you are yin and yang to data. That's how me and John have kind of synced together is, I'm the yin to his yang and vice versa. You can't be good at acquisitions without data, and you can't be good at data if you can't implement it with acquisition. So being able to, take the data and make sense of it to acquire the best cash flowing properties is really what I am known for and do on a day-to-day basis.
Yeah, appreciate it. Taylor is quite literally the yin to the yang. He's like my right-hand man. Everything I do, everything that I have done and talked about where I'm like, hey, we've found all these properties and they're all cash flowing and they're all like great properties, blah, 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 100% success rate on finding cash flowing properties. it's half that job is Taylor, right? So, I'm taking too much credit sometimes. It's like I figured all this data out, and then Taylor goes and actually puts it into the real world, which is difficult. It's difficult to do. You can stare at spreadsheets all day long, but to actually make something come to life is difficult, right? So we're at about 49 people that have showed up so far. We got Christian from Aurora, Colorado. We got Clayton from Liberty. We got Joe from College Station, which is a market I actually have analyzed once before. I am very curious about College Station. I believe that's right next to Brian, right? We got Josh from Tennessee, JP from California. Appreciate you guys for all being here. This is awesome. I feel like we've, given enough time to get everybody here. And so we are going to jump into it. And for anyone who doesn't know who I am, my name is John Bianchi. I'm the Airbnb data guy. I analyze data really well. I've created 6 free courses around it. I have the best track record in the entire industry for finding the most amount of deals during the last 2 years, because it's one of the hardest times to actually find properties, right? With higher interest rates and properties doubling. But you guys are not here for me. You guys are here for Ryan. And Ryan is going to be the guy who's going to get into the STR tax loophole and share with you guys as much as we possibly can. So what we're going to be talking about today is how to unlock $50,000 in tax savings, around $50,000, where it all depends on your situation, right? With the Airbnbs, and Ryan Banky is going to be the guy to walk you guys through that. So I know that we, once again, covered this a lot last week, but we're going to be covering new things. And I'm actually just going to share what those new things are for anybody who's watching this that might be thinking to themselves, like, why do I need to watch this again, right? And what's interesting here is we're going to go through where to buy an STR to maximize your tax savings. This is pretty interesting and going to be pretty important for when you're actually searching for a property. Ryan has also passed an audit for his STR tax loophole. Like you went through that entire process. So looking forward to Ryan sharing that story. And then we're going to talk about cash on equity return. Is it worth keeping your STR? And this is going to be probably my favorite part of the whole thing, because this is where a lot of the math comes into play, and it's a big equation, and you're trying to make a decision using strategy. So this is going to be a fun one. Taylor's actually gone through this specifically himself, so he's going to share that story with you guys as well. So these are going to be the 3 new topics we're going to cover. We'll still cover some of the other stuff as well and get Ryan's opinion, but I think we're locked in and ready to go. Ryan, you ready to go?
Yeah, let's do it.
All right, let's do it, man. So let's start off with just explaining the STR tax loophole. Explain it however you want to explain it, whatever is the best way that you like to explain it to other people, just so that anyone who doesn't know it can get up to speed, and then we can get into the nitty-gritty detail of those 3 points we just covered.
Yes, there's a lot of things in the tax code. People, real estate investors, realtors, they call things loopholes, right? They say the 1031 exchange is a loophole. They say that various deductions are loopholes. All that stuff's written in the tax code, and it's intended to be that way, right? A true loophole is when Congress writes the tax code a certain way, and they're unknowing to what people like you and me would do. You see, when they wrote this rule for real estate investors, they anticipated people doing short-term rentals at the time were just hotels, big management companies. They didn't anticipate people, when they wrote this rule in the late 80s, early 90s, they didn't anticipate people like you and me owning short-term rental properties. They thought it was going to be big mom and pop management companies, et cetera. Where the short-term rental loophole comes in is there, up until about 1986, all income that you ever made was considered the same. So if you were a doctor making $500,000 a year and you invested in rental properties, you were able to offset that income with your rentals. And so that's how a doctor, a dentist, lawyer, et cetera, pays nothing in taxes up until 1986, because all their income was the same and they would be able to offset it. It was great. But in 1986, that's when Congress put a stop to it. And they basically said, hey, there's this thing called passive income. There's this thing called active income. And normally the two don't talk to each other. Normally, you have to be a full-time, what's called a real estate professional. So you have to be a realtor, a property manager, doing flips full-time, construction, and in order to use your losses to offset your earnings. Where the short-term rental comes in, short-term rental tax loophole, is you can work a W-2, you can be a business owner, you can be a nurse, a tech investor, you can be anything that you want to be in your full-time job, and also invest in short-term rentals if you meet certain exceptions. And just to dive into what those exceptions might look like, well, the first thing is really easy. You just have to maintain an average of 7 days or less guest stay, which is typically common in most short-term rentals. If you're doing midterm rentals or longer stays, you might you might violate this test. But I mean, most of my Airbnbs, we do typically 2 to 3 night stays. We don't really get much longer. Some markets are longer day stays, but as long as it's 7.0 or less, you check box number 1. And then the second box is you have to what's called materially participate. Now, we'll talk a little bit more about that, I think, later. But just remember, material participation, you basically have to be self-managing, okay? You can have a cleaner. You might have a handyman that comes there a few times a month, but you cannot have a full-time property manager. You can't have somebody there, boots on the ground day to day. You had to be the one self-managing the property. And there's hours thresholds that we might get into later on how to qualify for that.
Appreciate that, Ryan. Thank you. So, guys, just before we get into these next steps, right? Ryan has a calculator that you can use to be able to estimate what your tax savings would be on a property that you would get or a property that maybe you already have. And it's free. And he's actually going to be giving it away at the very end of the presentation. I meant to mention it earlier, but now that we got everybody here, I'm just letting you know that Ryan is going to be giving that away at the very end. Additionally, ask your questions throughout the entire presentation. Throw them into the chat, start asking. And we are going to have a live Q&A at the very end to be able to ask all the nitty-gritty questions that you're probably wondering, such as this 7-day stay. I know is one that we had last time where people were saying like, hey, what if I let somebody stay for 8 days? Does that mean I'd no longer qualify? And that's not the case, right? It's just the average throughout the entire time period has to be less than 7 days. And anything else you want to say on that, Ryan?
Yeah, I would say the last thing, just what this means in sort of layman terms is it's going to allow you to grow your portfolio a lot quicker because you're going to be, for every $500,000 property you're buying, every 400K or 500K rental property you're buying, you're going to save $20,000 to $25,000 in taxes. And that's money that you can then reinvest into buying more properties and funding your financial freedom quicker. So layman's terms, all the short-term rental tax loophole allows you to do is pretty much build your financial freedom quicker.
Well said. That's
I
good.
love that. That's such a good point because it's no longer just saving your income from your job. It's no longer just recycling cash flows from the property, but it is a true three-headed monster of the tax savings plus the cash flow from the asset plus you saving your W-2 income. And when you combine all three, it goes a lot quicker than just using two or one of those streams. So really, really great nudge there for people to realize that if you're only looking at this from one avenue, sure, it's the old get rich slow scheme. But if you want to, get rich quicker, you put in those 2 extra accelerants onto your formula and you're able to hit those goals significantly quicker.
Yeah, love it. Must be nice for you Americans, to be able to get that. Over here in Canada, we don't have any of that bullshit. So here's a Canadian telling all you Americans how to save your taxes. Let's get into it. So the next one we got is where to buy an STR to maximize tax savings. This is all Ryan. So I know you guys may be thinking, that we talk about where to buy properties and how to do that, how to find cash flowing properties. Ryan said he wanted to talk about where to buy STRs to maximize your tax savings. I did not ask him any additional questions because I genuinely wanted to see what he was going to say. But this is not me telling him where to buy. All right. So Ryan, please share your thoughts on this and let's get into it.
So the first thing that I would say whenever I teach this now is you don't want to buy real estate solely for the tax benefits. If you go into real estate thinking, oh, I can buy this property. It may not be the best property. It might lose money, but I'll bank myself out because I'm making 40, 50K in tax savings. You're in for a rude awakening because we've met people before where they say $50,000 in taxes one year, but their property is losing $1,500 a month. So in 2 years, less than 2 years, they're going to lose the savings that they got, and then they're going to end up having to sell the property anyway. So you'll always hear me say, and I've always said this, never buy real estate just for the tax benefits. It's got to cash flow first, and it also has to be aligned with your goals.
So Ryan, if I could just hop in real quick, Brandon talked about this last time too, and Taylor and I stress this as much as we possibly can. It blows my mind how you have these extremely smart people who are making a good amount of money in their career, and they are buying properties with the objective of breaking even for the tax savings. And they'll even say like, I'm okay with losing $1,000 a month because I'm going to get so much savings. And he goes, yeah, but what happens in 3 years from now? Right. And if your goal is to break even, I can almost guarantee you that you're going to lose money on that property because your goal should never be to break even. That should be your worst case scenario. It should be the exact opposite. Right. So anyways, I could go on a really long rant about that one. I'm not going to. I'm going to shut up. I'm going to let you keep going.
Yeah, so I've been teaching the short-term rental loophole for over 3 years now, helping probably at this point over 400 people one-on-one, and going through it and seeing different markets where people are investing in. California, Smokies, Florida, Texas, Tennessee, even by me in the Midwest. And I started to learn patterns over time about where are the more favorable markets to invest for tax purposes. And there are certain parts of the country that are more favorable for tax benefits than other parts of the country. So to give you an example, typically the Midwest, anywhere where the property taxes are low and the land's not worth a lot, you're going to get a lot more tax benefits. And the reason is because you cannot depreciate land value. Okay. So Midwest, like Kentucky, Ohio, Smokies are a great market for this, where the land is not worth a lot, you're going to get a lot of tax savings. And the best example of this, I had a client who bought $1 million property in Smoky Mountains one year, and she saved a boatload of money in taxes, probably over 6 figures in taxes. And then she bought another property in Gulf Shores, same price, $1 million the year after. And she saved only $30,000 in taxes the second year, even though she bought the same purchase price. And it's because the land in Gulf Shores is worth so much. It was worth almost 50% of the overall purchase price. So when you're buying short-term rentals, again, we're never buying short-term rentals solely for the tax benefits. But if you are a high earner, you're in a high tax bracket, and you need as much tax benefits as you can, you really want to look into this before you buy. Really, you want to look into it way before you buy, but also the market and the location of where you invest in could be based on the tax benefits that you're going to receive. And here's what I teach with this. There's 2 reasons why you're going to want to go through this exercise that I'm about to teach you guys. The first reason why is you want to know how much tax benefits you're going to get on your property. You want to know the breakout between the building and the land value when you're buying a property, so that way you can calculate your tax benefits. And to do that, you have to go on the county assessor website, look up the property that you're buying, and look at how their taxes are being assessed. Check out the building, the land value on that property. But more importantly, go check out comps. Go check out 5 or 6 properties that have been sold in the last year in that same market, similar bedroom, bathroom, square footage. And that will tell you what their building and land breakout is. So then you'll know what yours is going to be. And then more importantly, there's a lot of good realtors out there for short-term rentals. There's also, for people that are not working with, investment-specific realtors, a lot of the times they might tell you what you want to hear, such as the listing agent giving you the current owner's property tax bill and not the property tax bill when the property gets reassessed. And one of the good ways to figure that out is go look at comps of properties that just sold. Because if I looked at 5 properties and on average their tax bill went up 20%, well, in my pro forma, when I underwrite a property, I need to factor in the fact that the property taxes are going to go up. Okay. A sale normally in most markets triggers reassessment, not in every single market, but in most markets. And so 2 reasons why you do this exercise. Number 1, you figure out how much you're going to save in income taxes. But number 2, you're going to know, what is my property tax bill going to be after I buy this thing and it gets reassessed. 2 big things to keep in mind.
Ryan, that's a really good point. As someone who looks all over the country and underwriting, every state handles this differently. And, you have places like North Carolina where they reassess every X amount of years. I believe it's either 4 or 8. So you need to understand that schedule. You could get lucky and they had just done a reassessment last year and you're locking that in. That's the best case scenario. The worst case is you're buying right now and the scheduled reassessment is next year. Like you said, though, most states do operate on a new assessed value. So a new sale will trigger. So that is the vast majority. But when you do see unique things like North Carolina and other states, you can strategically take strong advantage depending where in the assessment cycle you fall. So going through that exercise of knowing what that state's practice is and how it works is a very critical thing. And I know that's something from an acquisition standpoint we take highly into consideration, and you should too, when you're trying to figure out, how do I maximize my tax savings with this STR purchase?
Yeah, and it just goes hand in hand. Like, you're going to go on that county assessor website anyway. You might as well figure out both and get it narrowed down to a T. Another thing that increases your tax savings is going to be how old the property is. Because if you think about it, you're depreciating the value of the building. Well, a 1970 building is not as valuable as a building that was just built last year. So typically newer homes are going to have more value to be able to depreciate rather than older buildings. Another thing is the property fully furnished when you bought it or not? Okay. If you're buying a property that's completely empty, empty as in, there's walls and there's studs and everything, but there's just no furniture or fixtures or things like that. Well, then you're not going to get any tax benefit of that because there's nothing inside of the property. And so that can sway tax benefits. The other thing that I recommend people to do, and it's actually probably the first thing that I do, is I try to do a bird's eye view of the property if I can. If there's a picture of it, I love that, because anything that's outside of the property that's not attached to the building itself is most likely what's considered a land improvement. So like a driveway, a paver set, a fence, most pools are, some decks that are not structural to the property. Those are considered land improvements. And so your eyes should light up when you see those types of things, because you know that those things can be written off in the first year that you buy the property, as opposed to having to depreciate over a slow amount of time.
Right. What about things to, speaking of exterior, things like adding in, stone fire pits, putting in, things like miniature golf. I know a lot of these are, land improvements type of activities. Do you want to speak to some of the actual physical amenities that, could be added to the exterior of the house? Pickleball courts, bolted down playgrounds, not the rinky dink ones that sit on the top, but, you want to talk on some of those exterior amenities as well.
Yeah, like the property that John helped us find in Hollywood last year, we added mural canvas in the back. We added mini putt, cabanas in the back. All those types of things can be written off in the first year. Now, this might be a little bit too advanced for today's call, but when you have a land, or when you have a improvement in your backyard, that thing either gets bonus depreciated or it gets expensed. Okay. If it gets expensed, if it meets certain thresholds and lower dollar amount purchase. So for example, like a mini golf course, it doesn't cost a lot to put that in. So something like that, you can actually write off as an expense in the first year rather than having to depreciate. And it's more advanced. I just wanted to lay that out there, is even when you go to put $50, $60, $100,000 into a property, you should also be doing an analysis of, is it better to depreciate this, or is it better to expense it if I can? Because if you can expense it, then that means down the road you don't have to pay depreciation recapture on that you just depreciated. But if you expense the thing, then it lowers your net income on that property, and you're going to have a harder time qualifying for a loan. So there's this fine balance that I teach our clients and investors about. How do you know when you should be trying to write off everything under the sun? And then how do you know when you got to pay some taxes so that way you can get financing and bankability? Because a lot of real estate agents, I know we're picking on agents, but they'll go make 130, 150 grand a year. They'll buy an $80,000 car. And they're like, great, I only owe half in taxes now. But then the bank doesn't add back the car. The bank says, hey, you only made 50 grand this year. Sorry. Right. So this kind of goes in, I would consider it tax planning, but it kind of goes above and beyond. It takes somebody who's been there before, like I have. When I bought my first property, I was a W-2 making $55,000, $60,000 a year. I bought a $250,000 property. That was it. My DTI was maxed out. I had to figure out ways to make more money, do seller financing, even though interest rates were 3% back then. Like I had to get creative, to buy my next deal. But I hope that helps.
Yeah, no, that's a really good breakdown. I love pointing out these nuances because there's so many layers to this, and you can't just take this one-stop shop approach that some people make blanket statements, whether it's realtors, influencers online. It's really understanding that there's, kind of tier one, and then there's tier two and tier three. So, obviously, we're not going to go super deep today, but I do love that you're touching on those nuances that do exist. And if you aren't working with somebody who can professionally break that down, you can make very non-strategic decisions that cost you more total dollars because you're not understanding the difference in how you should approach the investment.
Yeah. So well said from both of you. Just want to point out, we have some awesome questions coming through, like some very detailed ones. So we're going to have a fun time with those ones. Guys, keep bringing them in as we're going through this. Keep putting those questions in the chat there. But I think we're all wondering, this slide says where to buy STRs to maximize your tax savings. We just talked about finding places that have, cheaper land, but like what states? You know what I mean? maybe we don't have to go into the actual towns, but like what states are you thinking that have cheaper land?
Yeah. Sorry, I didn't want to spoil it for you guys.
No worries.
generally the Midwest are going to have low land value. Ohio, even Illinois, Smoky Mountains are a great area to invest. But truthfully, it's anywhere where that land value is just low. And you can find that out by going on the county tax records. I'm not going to say you're SOL if you buy in California or Florida or Gulf Shores, but the odds of the land being cheap there is like super low. I mean, the land's going to be high there. Now, I bring that up to say is because condos and townhomes, you typically don't own the land that the building sits on. Okay. You might own a small percentage of it. And so if you are wanting to maximize tax benefits and you're investing in an area like a California, like a beach market, a Destin, a 30A, you may want to look into condos and townhomes because although they don't appreciate as much as we would, and we have to deal with shitty HOA people and things like that, they will provide great tax benefits because you don't own the land that they sit on.
Well
Great
said.
little nugget.
Yeah. All right. So that helps. There's definitely markets, without saying the exact towns and cities within the Midwest, within those areas that you talked about, that definitely have some strong cash flowing opportunities. I know I'm super interested in Michigan right now, and that's an area where that is the Midwest, really, right? So you would definitely be able to find some good properties out that way that would give you a good tax benefits. So I think we're pretty good on this slide. We spent almost a solid 20 minutes just going through this one. So that's awesome. We had a lot to cover. I love these little nuggets that you're giving, Ryan. They're like these they're practical situations that people are going to find themselves in and what they have to think about. So keep trying to bring those up if you can. Let's go into this next one though, which I'm super intrigued by. And I'm sure a ton of people are, because I didn't even think about this until I heard a reel with you about how you passed the audit for the STR tax loophole. Like, it didn't even cross my mind that you would get audited for this and like to be concerned about that or to be worried about that, because this is just not my world, obviously. But yeah, like you passed an audit. So tell us the story. I'm sure everybody's wondering about this, and I'm sure you have a ton of tips as well that you can provide to everybody.
Yeah. So anytime you drop a loss on a return, it's going to raise some red flags. It's going to raise some eyebrows. And whether that's a rental loss, a business loss, your wife starts a side hustle that loses $3,000 a month. Anytime you drop a loss on a return, it's going to raise some questions, specifically in real estate. And just over the last couple of years, with the IRS hiring more auditors to come and audit people that, especially really in that, I don't know, they were saying 300 to 700K income range, 300K to $1 million range. They're really targeting, people of that caliber. And so what a normal audit, there's not really, you could do everything the right way. You could submit your tax return the right way. You could have the right financial statements. There's nothing really that shows up for an audit. Okay. You might have a high amount of interest expense like this client did, or you might have a high amount of depreciation expense. And that's typically how the audit starts, right? So the IRS is going to reach out with we call them love letters from the IRS, but they're going to reach out with these letters and, white and black ink. And it's going to say, hey, we are examining your return. We would love to take a look at two particular things. Sometimes it's one thing, sometimes it's two things, but this one started off with just a high amount of interest expense and a lot of depreciation. And those are things that you can't do anything about that, right? If you have a 1098 from the bank that says you paid 20K or 30K mortgage interest, and that's what shows up on your return, there's nothing you can do about that. You paid 30K of mortgage interest in return. But then, they start asking more questions, and specifically about the short-term rental loophole, they're going to want to look into things like, hey, did you rent a property out an average of 7 days or less? Did you meet the material participation requirements in order to deduct the losses against your income? They're going to ask you a lot of questions about, even beyond tax. They ask questions about, where'd you go to college? What did you study? What did you do the last 7 years? Why did you get into real estate in the first place? So they also take the time to learn a little bit more about you and your background. What I do tell people all the time is that if you're following what I teach and say, and you're using the templates and the tools and resources I provide, you shouldn't fear an audit because you're prepared. It's only it only sucks if you get audited if you don't know what you're doing and you just handed paperwork into your accountant and told them to file it a certain way. That's the people that I would be fearful of. But another thing we learned in the process is just the knowledge of the auditors when it comes to short-term rentals. They had no idea what Airbnb. This auditor had no idea what Airbnb was. Never heard of it. Didn't even know it existed. And then don't even get me started when we try to teach them about VRBO and then direct booking. Like they have no idea of this lingo that we're talking about. And so even kind of just the hey, your 1099 from Airbnb shows 100K, but there is only 94,000 deposited in your bank account. Normally, it's the opposite. The IRS is used to people depositing more money in their bank account than what they report on their tax return, you know. But it was like the opposite. He's like, I'm sure there's something here, but can you explain this to me? And so just understanding that the auditors that they have right now, they don't really know a lot when it comes to short-term rentals. So all this to say, if you have good financial statements, and good financial statements are not just having your books and records into your accountant. But if I said, show me where you spent $1,800 on that deck repair, or show me where you spent this amount of money on that, and you're able to pull up the invoice or the receipt, that's being audit ready. That's being prepared. Is there any other specific questions?
Oh yeah.
No, so, I was gonna say it's.
I've got one, Taylor, if that's okay.
Yeah, go for it.
I'm actually just curious on two things. So one is probably doesn't matter all that much, but are they emailing you or are you hopping on a call with them going through this?
So they traditionally the auditors before COVID, they would always come to you, or sometimes they would do what's called a field audit. They would come to you, or they would want to meet in person. This was all handled electronically over Teams or phone calls.
Okay.
And
so, okay. That was just a curiosity thing. I was trying to picture it in my head. Like, is this emails going back and forth or what? And then the other question, it's way more important, is how did you prove your material participation? So when we talked about this last time, it was like, hey, you got to have records to be able to prove that you put in more hours than anybody else and how many hours that everybody else worked if you're going for the 100 hours and worked more than anybody else, right? And for anyone listening to this, we will touch on the material participation section. And you can also watch the last webinar to learn even more about that. But talk a little bit about how you proved your material participation.
Yeah, the material participation, it's definitely not the most interesting stuff. It doesn't get people too excited, but it is super important. So the material participation, there's not a one way that you have to keep track of your time. The IRS says you could even write it on a sheet of paper with the dates if you wanted to. But a good time log has the date that you did the activity. It's going to have the property that you were working on. It's going to have the time that you were there. How much time did you spend? What did you do? Who did it? Was it you or your spouse? And then most importantly, it's going to have just a little thing in there of you could show us proof. So if I said, hey, I spent 2 hours today fixing my pricing on Airbnb to match my competitor or whatever, there's actually a tool out there now. I can't remember the name of it, but it records your screen the entire time. And so that'd be really good backup for an audit, is if you just constantly had your screen being recorded, kind of like cookies, but not really cookies. But you could have your screen recorded. Oh, here's me on Airbnb website for 2 hours this day, right? That's going to make you bulletproof in an audit. This person in particular, our client, they used an Excel template. So it was just an Excel template with those the factors that I just told you each day, every day, and you just have to make sure that your template corroborates with your story of where you were that day. Okay. So if in my material participation time log, let's say that I visited the Smoky Mountains to fix some properties, but the bank statement that I have that the IRS is going to ask for shows that I was in Europe or that I was in Jamaica that weekend, right? That's probably not a good thing. All right.
Probably
and
not.
So you really want to make sure with your time log that you're being reasonable with your hours. You're not inflating your hours. You're not counting hours that don't count. And most importantly, you're just a person that's credible and that they can rely on. So
the question on that is did you have to prove that no one else did more than 100 hours, or did you qualify for the 500 hour option?
Yeah. So what I can tell you is this taxpayer, they qualify for the 500 hour test.
Gotcha. So it didn't matter what everyone else was doing.
That's right. So they didn't have to, because they had 500 hours material participation in their short-term rental business, they didn't have to prove out anybody else's time.
Okay. And just for clarification, was it you specifically who passed the loophole yourself, or was it somebody else that you were?
It was a client of ours.
Okay.
It was a client of ours. It wasn't me. I didn't get audited yet.
All right. I watched 2 seconds of the video and I thought it was you. So that's my bad. So that's all right. You went through it with a client, right? So you helped them through it, and they're a client of yours, and they passed the audit, which is extraordinarily important, as we talked about last time, because if one of your people were to not pass, right, then an auditor may go, can I see one of your other clients, right? And then they go talk to one of your other clients, and then they realize that one also doesn't pass. And then they're just going to ask for all of your clients, and then you're royally effed, right? So anyways, Taylor, do you have any other questions on that?
No, that was great. I was just chuckling, imagining Ryan talking about digital guidebooks and early check-ins to an IRS agent who has no freaking idea about what Verbo is or a direct booking. And I'm just imagining the hilarity of teaching somebody who's not familiar with this asset class at all. And Ryan's going through early check-ins and digital guidebooks and everything under the sun. So it is crazy just to see that you're not just proving this to somebody else who knows about this. You're truly proving it to, hey, teach me as if I'm a fifth grader sort of thing. And so I do like the organization, everything you talk about, and how critical it is to have your ducks in a row, because it's not just leveraging the tool, but you need to have the tool properly filed, organized, and set up. Otherwise, you just carry that back end risk.
And here's the thing about this, guys. Like, the time to prepare for an audit is not when you get the letter in the mail. The time to prepare is that year, right? So this was a 2022 audit. We got the letter March of 2024. So this is a year and a half, almost 2 years after that tax year. Luckily enough, our client, I can't say much. They had really good finance background, let's just say, right? So they had good books and records. They had all these things, because I was telling them back in 2022, you're going to need this stuff and you got to keep track of it. Now, another question a lot of people ask, like, hey, does the cost segregation study get attached to the tax return? Does my hours log, do I submit that to the IRS? No, you don't. The only time you would ever show your time log to the IRS is if they ask for it when you're under audit. But he had that time log, and, that's one of the things that we made sure of is, hey, your time log is credible and you're not in Europe that day or Jamaica or whatever. And we're good to go.
Perfect. You have to do a little bit of work to keep records of everything, but then you get to save thousands of dollars. So I think it's worth every single penny that it takes to actually keep track of everything, right? For anyone who's probably sitting there being like, I don't want to do that. Be like, how much are you going to save, right? So anyways, I think we covered this one pretty thoroughly. So let's hop into the next one, which I'm excited for. So cash on equity return, is it worth keeping your STR? Explain what you mean by this, Ryan. Make sure everyone understands exactly what you mean, and then we'll get into the nuances.
Yeah. So when you start in short-term rental specifically, the number one metric that a lot of people and influencers and coaches like to go off of is what's called cash on cash return. So that's how much money do I have to bring to the table and put it into the deal compared to how much money am I making on the property. So just easy math. If I put $100,000 in to buy a $500,000 property and I was netting $20,000 a year after all said and done, well, my cash on cash is 20%, right? I got $100,000 invested and I'm making 20 grand a year. And typically a 20% cash on cash return, that's pretty good, especially right now. Now, as a seasoned investor, you kind of have to ask yourself, well, what are my goals? Because in my opinion, if your goal is to leave your job as quick as possible or to spend more time with your family or do these types of things, it's typically going to require you having more money. And you got to make sure that your money is earning as much as it should be for you. So comes a time, and this is for a lot of short-term rental investors, where over 2, 3, 4 years, they have so much equity in their properties, but their properties are still only making that same 20K in net a year. Okay. So let's say for that property that I bought, well, 3 years later, my equity in it's $300,000, but I'm only making that same 20K a year. It would take me 15 years of renting that property out just to make back what I could sell it for and walk away with today. And if I could redeploy that into other assets that are also earning a 20% cash on cash, most of the time people are 2.5xing their net cash flow just by doing this analysis. And so the thing that I always say, just to open it up, is cash on cash is a measure of, did I make a good investment decision? Cash on equity is saying, is this still a good investment decision for me today? Is this still a good property for me today after factoring in everything? And we didn't even really talk about, tax benefits and appreciation and loan pay down, which are things that you should factor in. But look, if your number one goal with this whole real estate investing and why you guys are sitting on this webinar with these three knuckleheads is to get out of your W-2 job and to stop working, you have to make sure that your money is working as hard as possible. And that's where I recommend doing the cash on equity audit.
To provide a little color, I was listening to a podcast years ago and was first introduced to this concept. They called it return on equity, cash on equity, really same concept. You need to constantly be looking at the assets that you own and not look at what your original cash on cash is. Like Ryan said, that's really a vanity metric for the first year of, did I make a good investment? Something that you can't go back on. You might be mathematically sitting on an original 20% cash on cash, but if your return on equity is an 8%, that is a lackluster investment. And if you know that you could take that equity and go invest somewhere else and get a 15, then the decision is yes. And so what's great about this metric, and I love being a former baseball guy, is numbers are numbers. There's no emotion, there's no thinking. They just tell you facts. And if you can factually know that you can take capital and go somewhere and get a 12, 15, 18, 20% buying a new STR, and you're currently sitting on an 8% return on equity or cash on equity, then the decision is yes, you need to sell that asset. And so those are the things that, really make this a great metric. Is it's never up for debate, or it doesn't bring your opinion on. And that's why I love the question in quotes. Is it worth keeping this STR? This metric makes it very cut and dried. It's very black and white, and there is no gray to this. And, personally, I've gone through this and trimmed fat in my own personal short-term rental portfolio. And, when I trimmed the fat, it just became on cash on equity. And it's a very simple metric to use. And it's why you hear a lot more seasoned investors talk about it than, more retail, superficial, kind of year one getting into the space metric. So I love this topic. I've looked at it personally and done it. And it's something that should always be done when you're dealing with assets that you own and growing your own portfolio.
So let me walk through an example here to make sure I'm understanding this, because I feel like both of you have far more experience with this than I do, right? So let's play this hypothetical game and tell me where I'm getting it wrong, all right? Mm-hmm. So let's assume that I have $100,000, I buy a property, and it makes $20,000 in cash. Therefore, I got a 20% return at that point. However, now today, I have $200,000 in equity in that property. The property increased in value. I still have my original 100 in there. It increased by 100,000. There's now technically $200,000 that I own within that property. And in that year, when I make $20,000 in cash flow again, I've actually only made a 10% return based off of the total money that's available, kind of like sitting almost like in a bank account, but instead sitting in the property, right? And so then the decision here is, should I sell that property, take out the $200,000, obviously through a 1031 exchange, and take that money and put it into another property? And in that next property, I want to try and hit 20% cash flow again, or 20% cash on cash again. But instead of doing it with 100,000, I'm now doing it with 200,000. And so instead of getting $20,000 in cash, I'm now getting $40,000 in cash on an annual basis. Is that right?
Yes, the math in that example is correct. You don't even have to go that extreme, because technically you could take the return on equity and getting that you were getting a 10 in that example. If you can go get an 11 somewhere else, you're statistically going to put more dollars in your pocket. Now, obviously the goal would be to significantly go above that metric and hit the 15 or 20, percent number. But technically speaking, anything north of 10 gives you a net positive of cash in your pocket. So to that example's point, if you could take that 200 grand and go get an 11% somewhere else, you're going to put more cash in your pocket at the end of the day.
Okay. So Ryan, in this scenario, I took advantage of the STR tax loophole on that first property. I'm now going to sell that property and 1031 exchange into a new property.
Mm-hmm.
How does this work with the STR tax loophole? Where am I doing the exact same process again on this new property? Is it because I already did it on that property? It doesn't translate over. I can't do it again on this one. Like, walk us through this scenario and how these two connect.
Yeah, a lot of times if you did a cost segregation study on the original property, you're going to want to 9 times out of 10 try to do a 1031 exchange to exit. And that's because otherwise you have to pay back that depreciation that you took in the first year, assuming whenever you place the property in service, right? So the idea is to trade that property for another property. Now, you're not going to get the same cost segregation results on that new property, because if you're just trading up your original basis, like let's say you had that 200K equity and you're taking that 200K equity and you're putting it into another property and you're only using that equity, you're not going to get more tax benefits because you're not on the hook for anything else. But if you went and borrowed more money for that next property and you took out another loan or a bigger loan, well, then you're going to get some more tax benefits on the table. But a lot of times when people are doing this, they believe that they have to buy another property, which 9 times out of 10, I think it's the right move. You know, if you in your example, John, you could be earning another 20 grand a year. So it's actually costing you 20 grand a year not to make this decision if you know that you can earn that modest return, right? So it's the opportunity cost of, hey, I'm sitting on $200,000 of equity that should be earning me 40 grand a year. It's only earning me 20 grand a year. I need to go trade it up for something else. I think that's important. But also, you know, we've even helped people scale down their portfolio by doing this analysis. We've helped people sell a property, pay off some HELOCs, pay off some credit card debt, pay off some high interest debt that's at 8-9%. And here's another thing, I'll throw this out there. Not a lot of people are factoring in time on hassle. I call it return on hassle, time on hassle. So if I got a chunk of money, right, and I got a 9% interest rate on something, right, a HELOC or a car note, whatever, I really need to earn like 25% or 20% in an investment somewhere else other than paying down that HELOC, right? Because I have to not only cover the 9% that I am paying on the HELOC, but it also has to be worth my time to go do that investment decision. So that's how I start thinking about things now. It's not just these percentage numbers, but it's also like, what is my time worth to go and do that?
I love that every person. So I always look at ROH, return on headache. So, you know, if you notice that we're all talking about the same stuff, and, you know, Ryan's terminology might be slightly different than my terminology, and it's all kind of like where you consume and learn, but it's the same concepts. And, you know, that's what's really powerful about this stuff is everybody's looking at these metrics, especially seasoned investors. And yeah, I always go for what's my ROH, my return on headache. And it's a good metric to always take into account because you only have 24 hours in the day. You know, none of us were blessed with more than 24 hours in a day. And so we need to be efficient with that time and then ultimately be efficient with our capital. And, you know, those two things together both make a decision worthwhile.
So this has been awesome. This has actually just been such a different conversation than what we had last time. So I'm loving this, and we're going into so many details. I appreciate you, Ryan, big time. We're at 48 minutes right now. We have a whack load of questions we got to go through. The other things we were going to potentially talk about were, you know, material participation, the rep status, and, you know, walking through the STR transaction. But we covered those pretty thoroughly in our last one. And so this has been a great different perspective. It's almost like, you know, we explained everything in the last one, and then it's like, okay, let's actually put it into practice. What does that look like when you put it into practice? What are the different scenarios we're going to run into, and how's it all kind of come together? And I think we have a ton of additional questions that are even more specific that are going to help us get through this as well. Before we get to these questions, I just want everyone to pull out your phone right now. Pull it out and pull up the camera and scan that QR code, because Ryan's going to give you his free deal calculator. It's going to cost you an entire email. So you have to give him an email. And then once you give him your email, you're going to get a free calculator, which I think is well worth it. Right. So I'm going to leave this screen up for a little bit. and then we're going to get into the questions. Before we do that, Ryan, do you want to explain anything about this, or do you think we're just good to hop into the questions?
Yeah, the calculator itself, it's going to teach you what your cash on cash is before and also what your cash on cash is after when you factor in the tax benefits. Remember, we don't want to buy real estate just for the tax benefits. But another thing that I teach in that calculator is my metrics to underwriting a property. If you can get your gross revenue to be a certain amount of the purchase price, and you can keep your operating expenses to a certain percentage, and you can keep your debt service to a certain percentage, there's no way that you lose in real estate unless something dramatic or something happens that's outside of your control. But if you can learn and use those principles, you'll be a better investor.
Nice.
Taylor, does that have your wheel spinning?
I love it. This is the stuff the Kool-Aid that I drink on a regular basis.
Taylor's the underwriting man. He should be the STR underwriter. That's really who he should be. All right, let's get into these questions. Very first one is this one right here. Is this tax loophole expiring, or is that just cost seg that I'm thinking of?
Yeah, so the way the tax law is written now, the STR loophole itself is going to be lived on forever until they rewrite the policy and they change that. As far as cost seg is going down, right? So it was 80% last year, it's 60% this year, then it goes down to 40, and then ultimately kind of just evaporates, and it goes back to what the rules were before. So if you're still at high income tax bracket this year, I still think it makes sense at 60%. And even if you bought properties in previous years where you're just learning about cost segregation study, there's avenues where you can go back in time and take advantage of that cost seg study or apply it to your current year situation too.
Beautiful. Next one here is, if taxes on extensions are due at, was that 10/15, October 15th, is there enough time left to do a cost seg on an existing property? Is there a threshold of income where it is worth it to do it to offset income?
So this is going to depend on if you're going to I still think you have time, because here's the thing. If you do the cost segregation study, and I don't know much about the situation, but if you do the cost segregation study and you're due a refund on a federal level, it doesn't matter if you submit your tax return late, because the IRS owes you money. They actually don't want you to submit your tax return on time, because then they have to pay you money. So if you think that the cost seg will allow you to get a refund, then it doesn't matter if you file after October 15th. Is there a threshold of income where is it worth? Most of the time, I would say you want to be in that 24% bracket, at least 24 or 32% bracket. That's when it makes sense. I think there was another question that was right below this where they said, hey, does it ever, can you pull that one up by Robert? It says, does it ever make sense not to do a cost segregation study?
This one here?
Yeah. So there's some very oddball cases where it doesn't make sense to do it in the first year. So for example, like
this one here.
Yeah. Let's say you bought a property in 2023 and you didn't have a good year that year income wise. Like maybe you got laid off halfway through the year, which is what gave you so much time to go and buy a property in the first place. You don't want to take depreciation when you're in a low tax bracket. I'll tell you that right now. So if you predict yourself being in a higher tax bracket in the future, it's worth waiting to apply the depreciation till when you're in a higher tax bracket.
Great answer there.
Yeah.
Okay. And I think this is same idea.
Yeah, same concept.
Okay.
Yeah.
Okay.
Mm-hmm.
We have another question here from Karen. What is the best way to maximize buying land and then building? It can take a while to build it. Are there any tax benefits right away or only after construction?
Certificate of occupancy.
Thank you.
Yeah, when you're building, you don't get tax benefits until the property goes live in service. Just remember that. You're not able to write off any of the costs. You're not able to deduct anything until that property goes live. I've seen investors make the mistake of like spending a couple $100,000 between October and December, thinking that it would save them money in taxes, and they're in for a rude awakening most of the time.
Okay. Next one. Are there tips on appealing the tax bills to reduce or force the tax bill to hold for a while so there aren't annual increases?
That's a Taylor ballpark.
Yeah, I mean, some states have appeals. There's companies out there that you can pay kind of pro bono that will file appeals on your tax benefit, and they only collect a fee if you are able to reduce your taxable income. The successes are very mixed bag, what I've seen. So when you're looking at what the assessed value is and the taxable value of the property and the land, you can obviously file the appeal yourself. There's firms that specialize in it on a state-by-state basis. Like I said, most of them will work on a kind of success rate. So, they'll take a percentage of the successful, reduction. Again, until you get into these big multi-million dollar properties, when we're talking about $400,000, $500,000, $600,000 houses, some of these appeals are yielding, $200 to $800. Plus, if you're giving up a percentage of that, I've personally never felt the headache of the time. So ROH being worth it is a really good example. Is, hey, if I go through this whole process, I might be able to save $400. You really just need to see what your time's worth in fighting that estimated tax bill and appeal with the county or the government entity.
Okay. Another one here. So along the same lines of bonus depreciation versus expensing, do you look into Section 117 with bonus depreciation rates declining? It seems like Section 179 is ahead right now despite limitations.
Yeah, so that's a lot of granular stuff there. But so Section 179 is its own tax code. And bonus depreciation is its own tax code too. It's just 168K. It's not as famous or catchy as 179. One of the things a lot of people don't know about short-term rentals is because they're considered commercial property, you can actually use Section 179 on short-term rentals, whereas opposed to long-term rentals or regular multifamily, you're not able to use Section 179 on those assets because it's typically only for heavy equipment or machinery or vehicles like that. But in certain use cases, using 179 could be more beneficial than bonus depreciating.
Okay, perfect. Next one. This person is saying they have a large tax burden and they're just wondering essentially what we were able to do to help them. So I'm just going to say quickly that Taylor and I can find you a property that will cash flow, and then you can hop over to work with Ryan, and Ryan will help you with everything, taxes and accounting and STR tax loophole. Anything I'm missing there, Ryan, that you can do?
No, we could help you start to finish, even just figuring out what market to buy in if you want to offset the most amount of money in taxes. You've heard a little bit more info on this call today, but the location of the market's super important, and then just having the right team to help you find the property, and then to make sure that you don't go to jail when you file your tax return. So
beautiful. So another one here. So what do you need to prove that you did more than others? How do you prove what amount of time your cleaner is there?
Good question. So you're going to need to have that time log. And then you typically are also going to request that the cleaning company provides you their hours. Another thing too, I've noticed at some of my newer properties, we have the key cards for each cleaner. And so when they open the door, it logs their time online, and then when they leave, assuming they remember to do it, it'll register the time when they leave. And so that's been a great way to track the amount of time that the cleaners have been spending. But other than that, you just ask them how much time that they spent in your property.
By the way, let's give a shout out to Karen, who has just added so many questions and is, asking a lot of questions that I bet a ton of people are thinking. So here's another one. What if your return on equity indicates you should sell, but you aren't in a position to 1031 right away? Is it still worth it in 2025 to sell and purchase instead of 2024 since the cost seg is lower? Taylor, it seems like you want to take this one.
Yeah. So return on equity isn't necessarily looking at the tax benefit as much as the cash flow side. So the whole year isn't necessarily where ROE is coming in. It's just in plain terms, I have cash only making 20 grand a year, but based on the amount of equity in this property, I could move it somewhere else to get 40,000 a year or 30,000. It's more of an opportunity cost than it is a tax metric. Now, there can be tax implications if you took depreciation. So like Ryan said, recapture taxes where you will need to 1031, but it's not necessarily tied to the tax year. Oh my gosh, taxes are running out. You can still run return on equity in 2026, 2027, 2028, because it's just sheerly the amount of cash that you're generating from your assets with what you have. So ROE, yes, tax benefits do come into it, but it's not a primary driver. The primary driver is the cash that you're generating today versus your equity.
Yeah. And it could be a big factor, knowing what your tax bill would be if you sold it without a 1031. And I think that's important for people listening right now, because if you go and sell a property, let's say September 1st, or what are we're September 5th now. Let's say you go sell a property October 1st, and you're not going to find out until March whether or not your 1031 is successful or not. So let's say it's February and you didn't find a property yet, that tax bill is due on April 15th of 2025. So in cases like this, where you're coming up on the end of the year, it is almost better to sell the asset in 2025, because that'll give you an entire year to plan around potentially failing the 1031 exchange.
Yeah, it's definitely still, the tax side still always is an implication, for sure. But just broadly, the ROE is really just looking at the cash flow versus the dollars sitting in the asset.
Yeah. Mm-hmm. Also, if you're in a rush to find an Airbnb, we have them ready to go. So
I was gonna say,
calling that out, right? If you want to get it done, you can get it done fairly quickly with us. This one here, can you just do a HELOC in this example and not sell the first property? So this person posted this question when I was asking both of those scenarios, where it's like, we have the first home, $20,000, and then we buy another home. Could you just HELOC and buy another home? Like, what's the thoughts there?
I'll give my opinion on this. I wrote this email. I sent it out to 11,000 investors last month, and the title of the email is "Why Short-Term Debt Doesn't Work in Short-Term Rentals." And it's because of the math, right? So if I take out $100,000 HELOC on a property, my interest rate right now is going to be 8-9%. Let's call it 9%. I'm going to take that $100K. I'm going to go buy a $500,000-$400,000 property. What am I going to net on the $100K? I'm going to net $20K. Well, after that $20K, I still got to pay $9K to pay down the HELOC, right? And so then I'm only left with $10K left over cash flow if I'm lucky. So sometimes it becomes incredibly hard, depending on the interest rate environment, to do that. And the actual better alternative is to just sell the property and buy a new one sometimes.
I'm in full agreement. It's so hard when you keep layering in multiple layers of leverage that sounds good in theory. Hey, I want to keep the asset, but you could still run a true return on equity with the HELOC. And when you're sitting there left over with 8-9K on a best case scenario, like Ryan just laid out, it's going to tell you that no, a HELOC is still not the best ROE, because you're still almost breaking back to where you're at. And you're like, man, I'm back sitting at a 9-10% return on equity in this example. So you still almost finish at the same place that you start. And I've rarely seen it where it comes out ahead. So I'm really glad you walk through that example, because you normally end up right where your feet are currently standing today. And now you just took out more debt and more leverage. So you just carry more risk to end up in the same position.
Love that. That is, in other words, guys, it's a math equation. Just run the math, run the scenario, figure out which one makes sense. We got a handful more here. We're going to keep ripping through. Ryan, you still good to keep going?
I got about another 5 minutes. Yep.
All right. Well, I had plenty of time. When is it worth it to just sell, take the hit with the long-term capital gains, and wait to purchase something else, or possible?
Yes. I mean, sometimes that's not the answer that people want to hear, but it's the answer that they need to hear, is just selling the property, eating the tax bill, and moving on with their life. It really does come down to personal preference. And, even if you were to sell your property, because in some cases, some people buy properties for $400K that went up to $1 million in the Smokies, right? So now somebody started with $100K of equity and it turned it into $700K of equity. Well, what does that $700K of equity get you? That thing's going to get you like easily over $2.5 million worth of real estate if you wanted it. But does the person who bought previously a $400,000 property have the mindset and the ability to go manage $2.5 million worth of real estate? Maybe not. That's when you sell and you just pocket it and figure out what to do with it later. That's my opinion.
Great point. I'll tell you transparently, I have done 1031 and I've sold and sat and paid Uncle Sam more than I wanted to. I think it's very situationally, and to make a broad statement, like, sure, the goal is to always 1031, but based on the situation I was at with the particular asset, is one of those you take it on the chin and regroup and kind of replan. So yeah, it can sometimes work out. And I've done both ends of it because I've been in different spots in my life and my investment journey and what was being yielded from that asset itself. So it can make sense. It definitely can. And I've done it personally. It's not fun, but it has made sense in the long run.
Yeah, but you had a game plan for doing that. Like you're planning on doing something else, and so you had to keep that money out of a home.
Yeah, no, I mean, that's what I said. You need to understand your situation. So, sometimes it can make sense to take it on the chin, and sometimes it makes sense to 1031.
Okay. Ryan, can people consult with your firm structuring their LLC? He has a JV and some unique circumstances that he wants to consider before executing an operating agreement.
Yeah, so what we do in Tax Strategy 365, it should be Tax Strategy and Legal 365 because we also help our investors figure out what they should be doing from an asset protection standpoint, from a tax perspective. I'll never forget this one time. We brought on a client. We were reviewing his operating agreement. So let's just call them Joe and Jim for this example. So Joe and Jim own a property that's got $500,000 of equity in it. In the operating agreement, said if Joe dies, his ownership interest goes to Jim. And if Jim dies, his ownership interest goes to Joe. It didn't say it goes to Joe's kids or Joe's wife or Joe's family. It said Jim. And had we not have reviewed that and one of them would die or pass away, like their kids would have missed out on $250,000 of equity. So that's one of the things, you definitely want to have somebody review that, whether it's a lawyer, a CPA, because it could save you $250,000. Well, I called the client. I was like, hey, you know that your operating agreement says if you die, Joe gets all your shit, right? He's like, no, I didn't sign off on that. But that's what happens when people go with like a LegalZoom or a cookie cutter service, unfortunately.
Can one leverage bonus depreciation and cost seg to offset W-2 income well on an H-1B visa?
Yes, we've had people do that before. Yes.
Interesting. Do you know if you guys are looking for a cost seg company, you can email either of us. I'm sure we've got people we can send you. This one is there a calculator to find out what your taxes would be on the sale of a home? Is that what your calculator does?
No, not that one. That one is buying a home. I do have a calculator for this. Unfortunately, I can't give it out for free because it would be almost malpractice for you to try to do it on your own.
Gotcha.
So we only have it inside of our client community.
Okay, so, gotcha. And then we have this one here, which is saying, does time spent in acquisition phase be counted for material participation when using turnkey STR companies?
No, probably not. Those are going to be considered investor level hours. Time spent before you close on a property. So those hours are not going to count.
Yeah, that was the same thing last time. If I sell a property out of country, can I do 1031 exchange to buy a property in US?
Nope. They both have to be US based property.
All right. Yeah. That's all of them. What were you going to say there, Taylor?
I was going to say, no, want to be respectful of Ryan's time.
Yeah. This is, you guys, before we hop off, let's all just thank Ryan for being here. Throw something up in the comments. Let him know we appreciate you. Pull out your phone, guys, as well to be able to get Ryan's information right there in the QR code or our information. But Ryan, before you leave, anything else you want to say?
Don't wait to invest and wait. It's always the right move.
Say that one more time.
Don't wait to invest and wait.
Don't wait to invest and wait. Love that. That's beautiful. Yeah.
Perfect.
We appreciate you, man. I appreciate you big time. I'm looking forward to seeing you again in person. Taylor, thank you for being here as well. And everybody else, if you found this useful, share it with somebody else who also might find it useful. Thank you again, and we'll see you guys later.
Next time, guys.